When you look at the information that is captured, particularly for a bear trust, on the jacket, it's basically, account name, in trust for, or in terms of real property, name of child with parent. Provides parent's address or child's address on the jacket, but no income, no asset, no fair market value of the asset, no income or gains that pertains to the asset is reflected on the T3 jacket, nor on the Schedule 15. So I have to question, what's the usefulness of this information other than you're providing transparency and you're providing CRA essentially with beneficial and legal ownership of assets.
Welcome to Strictly Money, where finance and your prosperity meet. I'm Sejal Patel. Trusts are an important financial planning tool for a lot of families, but the federal government has introduced new trust reporting rules that come into effect in weeks, and it's raising a lot of eyebrows. For one, a lot of people don't know about it, even though it could impact them. And two, the penalties are very steep if you don't comply. Now, a lot of tax professionals and accountants have raised their concerns, but unfortunately, it has fallen on deaf ears. So today we are going to talk about this. Joining me is Michelle Connolly. Michelle is not only a dear friend, but she is also the Senior Vice President of Advanced Tax and Estate Planning with Wellington-Altus, and she's going to explain it all. So, Michelle, there are these new trust reporting rules. I don't know, well, not you, because you know what's going on, but I certainly find it quite confusing. I know a lot of people do find it confusing. And more importantly, a lot of people don't know that they may be obligated to actually report this to the CRA. So I wanted to do this show to clear up some of the misconceptions. So thank you for coming on.
Well, it's always a pleasure, Sejal, in terms of chatting. And in terms of, I applaud your initiative in terms of sharing great wealth knowledge. So let's start off with the basic understanding of a trust and the types of trusts that are commonly found in Canada. So we have mutual funds, ETFs, RSPs, RDSPs, TFSAs, FHSAs. All generally registered plans in Canada are in the form of a trust structure. However, we also have inter vivos trusts, which are created by a live individual, or testamentary trusts that are created upon the death of an individual. Every Canadian generally creates a trust, their estate, upon their passing. When we look at a trust, the purpose and intention is to separate and divide legal from beneficial interest. And that's where the confusion comes from. And in terms of when you look at these enhanced trust reporting rules that we're going to focus on today. So if I give you a $50 bill and say, Sejal, here's my gift to you, you are both the legal owner of that $50 bill, and you can also enjoy and benefit from the $50. You can go buy a good bottle of wine, you can invest, which you are very capable of. You also benefit from that $50. With a trust, the trust is the legal owner of the $50, but the trustee is empowered or guided by the trust document to invest or do whatever it sees fit with that $50 for the benefit of the named beneficiaries. Now, the beneficiaries in this instance don't control the property. They just simply receive and are blessed with whatever the trustee distributes out to them. So common inter vivos trusts today in Canada are family trusts, Henson trusts, spendthrift trusts, which are all created and are generally put forth due to a beneficiary interest or concern.
Let's go back to the reporting requirements then. So the trusts, the way it's set up now, Michelle, my understanding is the reporting requirements were pretty limited, right? They'd still have to fill out this T3 trust income tax return, but it typically is when they have to pay tax or they dispose of capital property or they distribute these assets or whatever it may be to beneficiaries. Is that correct?
Absolutely. So prior to December 31st, 2023, express trusts, formal trusts, had the obligation to file a T3, which is a trust income and information return, if they generated income, tax liability, or made distributions out to their beneficiaries. They did not cover off. So, in the instance, there was no income, there were no distributions, or it was a bare trust, they did not have to file a T3. Now, the enhanced trust reporting rules, which were introduced back in 2018, basically said for trusts or trust like relationships that have a reporting deadline or year end deadline after December 30th, 2023, are now going to be subject to the new enhanced trust reporting rules. Well, Inter Vivos trusts in Canada have a December 31st year end by default. So, all in terms of Inter Vivos or express trusts that have, and these bear trusts that have December 31st deadlines or year ends, are now subject to the enhanced trust reporting for 2023.
Okay, so what I want to understand, Michelle, is this legislation that again was introduced back in 2018. It's ultimately passed now, so it's taking effect. My understanding that is that it's expanded to cover bear trusts. What are bear trusts?
So when we look at bear trusts, let's go back to the fundamentals again. A bear trust is a relationship whereby the trustee only holds legal title to the trust property as opposed to legal ownership, which we typically see in regular express inter vivos trusts. And the beneficiary has a beneficial ownership as opposed to a beneficial interest, which you see in a typical express trust. So the relationship between the trustee and the beneficiary is much different in a bear trust situation. The trustee doesn't oversee or make any decisions regarding the trust property. The beneficiary does in this instance. So the trustee for a bear trust is essentially an agent.
Ah, okay. So some people might not even realize that they're in this situation. So we are going to, Michelle, run through a couple of examples. But first, we want to hear from our sponsors. Without, I could not be doing this show, and that's BMO ETF. So we'll hear from them, and we'll be right back. Welcome back to Strictly Money. I'm here with Michelle Connolly, and we're talking about the new trust reporting rules. Now, Michelle, I think the point that we want to try to make, or I'm trying to make, is that these trustees, they need to understand that they may now have these reporting obligations. So can we just run through some examples that might be common? One of them is, and because we see this a lot, the bank of mom and dad, right? And so this is where a parent is helping a child to buy a home, and in this case, they may be co-signing a mortgage for their son or daughter. Would this be considered a bearer trust?
Yes. So when we talk about the concept of a bear trust, two common bear trusts that we're seeing are jointly owned investment accounts and real property ownership, where a joint owner does not hold beneficial ownership, but only, legal title. So let's first talk about the joint accounts and then let's get into real property. So many Canadians are joint account holders of their parents' non-registered investment accounts, or parents have in trust for accounts for their minor age children. If the parent or child only reports income and gains, and the account only lists their social insurance number, this is a bear trust arrangement. Also, if a parent was required to go on title of the child's principal residence as they co-signed the mortgage, this is likely also a bear trust arrangement. The parent in this instance is only on legal title, whereas the child oversees the residence, covers the bills, possesses beneficial and legal ownership when eventually it is sold.
Okay. So then, as would the parent be obligated to file that T3 or whoever is on title?
So, in terms of talking about this, let's look at the reporting obligations. So, to date, Express Trusts have only had to file the T3, the Trust Income and Information Return. What's been added this year is also, in addition to the T3, is a new schedule called Schedule 15. For a bare trust arrangement, what will happen is there will be a jacket of the T3 that is completed on behalf of the trustee. And then, in terms of the related parties or interested parties, beneficial parties to the trust arrangement, will each have to complete a Schedule 15. So that will include a trustee, that will include a beneficiary. In the instance that it is an express trust, settlor or testator, and then also someone who may have oversight. So, where you have a parent that is on legal title with their child in terms of the child's principal residence, both the parent as trustee will have to complete Schedule 15, and the child as beneficiary will also have to complete Schedule 15. Now, what's really interesting about this whole bare trust and including it as a trust like relationship is, why is CRA doing this?
Yeah. That was my question, is why are they doing this?
You know what? Natural segue. We always have great conversations. When you look at the information that is captured, particularly for a bare trust, on the jacket, it's basically, account name, in trust for, or in terms of real property, name of child with parent. Provides parent's address or child's address on the jacket, but no income, no asset, no fair market value of the asset, no income or gains that pertains to the asset is reflected on the T3 jacket, nor on the Schedule 15. So I have to question, what's the usefulness of this information other than you're providing transparency and you're providing CRA essentially with beneficial and legal ownership of assets?
I got to tell you, Michelle, I get very concerned about this because I just have to think that this is going to completely backfire on the federal government and the CRA because, Michelle, most people don't even know what their obligation is. They're going around, and I have this conversation all the time. Like, I have a friend who's just managing a bank account on behalf of their senior parent. There's just a joint name on it, just in case, right? It's part of it is to avoid probate. And they're thinking, well, why do I have to do this? I don't know if I have to do this. Like, where's the obligation to inform people? Because it doesn't seem like people have it.
No, you're not alone, Sejal. And when you look back over the last 6 to 8 weeks, you've seen in the media, and kudos to you in terms of raising awareness of this potential filing obligation. Awareness and timing of the enhanced trust reporting rules is really, we've been reporting on it or trying to raise awareness in terms of, I'm with a wealth dealer, the last 6 to 8 months. We've raised awareness in terms of our budget commentary and in terms of, are you in this particular situation? But also, we're also typically aware of where there are joint accounts or in terms of parents have loaned money or perhaps are in that bare trustee relationship dealing with real property. The uncertainty around these rules and lack of awareness is twofold. Number one, when we're looking at the enhanced trust reporting, you have to consider trust law. You have to consider income tax law, and third, succession law. Because more often than not, when we look at these joint accounts, it was primarily from a succession law perspective, like saving on probate, time of just moving the account over, to the children easily out of the estate. But from a timing perspective, all right, and again, awareness, these returns are due. So for trust reporting, the trust income tax and information return, including Schedule 15, is due 90 days after the trust year end. So December 31st, 90 days, because 2024 is a leap year. We also have Easter weekend. The T3 returns, along with the Schedule 15 as appropriate, are due Tuesday, April 2nd. All right, so April 2nd. Now, most of us, in terms of preparing our personal tax returns, all right, are engaging and having dialogue with our tax specialists or accountants for the month of April, which follows after in terms of the trust reporting deadline. So I've seen a flurry of emails from accountants and tax tax accountants, tax lawyers sending out awareness, like, are you in this situation? Be aware of these rules, particularly the last 2 weeks. Everybody is scared. Now, with respect to the Bear Trust situation, CRA, even as of yesterday, released an announcement that they are going to provide relief to Bear Trust. They're viewing 2023 reporting as an educational year, that they'll not assess the penalties if the return is late filed. Because they realize, or hopefully they realize, that the lead up to this, there has been a lot of misunderstanding, not clear communication, or awareness, particularly aware of Bear Trust relationship.
Yeah. Do you know if banks are actually obligated to send something out to their clients?
Ultimately, I don't think so. And I know that, in terms of there's reporting rules with respect to fiduciary responsibility, with respect to advisors, from that. Where trust accountants or trust lawyers are in place with express trusts, the obligation to file the T3 has always been in place. Unless, for this year, there's new reporting obligations because the fair market value of the trust property is over $50,000. Express trusts that were created to hold recreational property, or express trust, say you've got a family trust above a holding company or an operating company, and there's been no income or dividends paid up, have never had that obligation before. They do now. But from a fiduciary responsibility, the obligation ultimately is on the taxpayer. And that's with all things CRA, that you have a duty to report. So in terms of raising awareness, again, kudos to you, kudos to the tax community, just to ensure that our clients and in terms of Canadian taxpayers are aware of these rules and therefore can be compliant and file accordingly.
Yeah, at this point of the ownership or the onerous is, it's on the taxpayer, and yet so many taxpayers don't even know what their obligation is. And let's face it, Michelle, a lot of people are not financially literate. I mean, it took me, and I've been in the industry for a long time, but it took me some time to just understand the trust versus a bearer trust and obligations. The other question I had, Michelle, is okay, there's the reporting obligations. Are there tax consequences that are going to change?
So there's no fundamental difference in income tax calculation with respect to trusts, like in terms of how a taxable income is calculated or the distribution. So when a trust, like if it's a commercial trust such as a mutual fund or an ETF, distributes T3s out, there's no change in that. When you look at the common inter vivos trust, again, if there's distributions made out to beneficiaries or calculation of income, there's no change. It fundamentally comes down to the reporting obligation, enhanced reporting, and then the addition of the Schedule 15. So, with that, raising awareness, what do you in fact have to report? I step through it. I'm a tax accountant, and my mother has a joint account with her sister. So in terms of going through that, the account is worth more than $50,000. So I've prepared, a T3 and a Schedule 15 for the two of them. I also have in trust for accounts, I have two children that are minors and that they've received income. And in terms of, whether from summer jobs or in terms of being a beneficiary, I've had to prepare that. And it's only the exercise of stepping through, preparing those schedules, the jacket for the Schedule T3 and then also the Schedule 15, that I can talk to you today with clarity as to what's involved.
Yeah, I can't imagine someone who's completes their tax return on their own and be able to get through this. But I guess time will tell. I do want to mention the penalties. It looks like this year they're going to be easy on people, but it's pretty hefty. $25 per day that you are late to a maximum of $2,500 per trust.
Actually, Sejal, it's even more punitive than that. And so keep in mind, you're looking at, so through the T3, the general T3, they're only providing sort of a give me CRA for Bear Trust this year. All right. Where it's a formal express trust, the new penalty, there's a second penalty on top of the filing penalty, that where there's been deliberate or intentional underreporting, or in fact have not prepared, the penalties are far more punitive. And just tolerate me, I'm just going to double check. With that, it is a minimum of $2,500, all right, to upwards to 5% of the fair market value of the trust property that, and that's on top of, and that relates to the enhanced trust reporting. It's very punitive in terms of like CRA. When you look at this in finance, you know, it's sort of been a take of this government that they want transparency, they want appropriate tax reporting. And in order to get that, they've captured a lot of Canadians that unintentionally, and they're being really punitive in that regard.
And how do they know that someone's being intentional? I'd like to see them argue that. How would they prove that? Yeah.
Good question. Like on it, like in terms of, I think it, when I look back, like they're trying to drive behavior. Maybe they found that people are not reporting trust relationships appropriately. Can't say.
Oh boy. I guess time will tell, but I think this is going to backfire. I guess we'll find out soon, Michelle, when April and May rolls around. Can I just ask you then, when it comes to trust, and this is sort of related, but when it comes to the role of trust, when does it make sense to create one?
It's a great question. And what I will say fundamentally is don't be scared by trusts. In the wealth planning community, in the tax community, trusts are a vehicle that are often used and where appropriate. So there's a clear distinction in my role. I look predominantly at addressing a beneficiary need. That trusts come into place where you want to separate out legal ownership from beneficial ownership. Where you have a minor child. Grandma and grandpa is leaving them an inheritance, but the child is under the age of 18, or grandma and grandpa are not aware of their financial literacy, ability to handle such funds. There is a trust set up in their will. Or in the instance that you're looking at intergenerational transfer of a business. All right. Mom and dad, have worked hard for 20 years in the business. Several of their children now want to be involved in the business. Often a trust is put in place as part of an estate freeze to facilitate handoff. Trusts are also a really useful vehicle, and it's not just generated at tax savings. In that instance, trusts are a vehicle where you're, again, addressing a beneficiary need. If you've got a spendthrift beneficiary, all right, a Henson trust, all right, where you've got a beneficiary with special needs and addressing, tax planning, the ability to access public support, a Henson trust can be put in place. Also look at modern Canadian families, all right, when you're dealing with second or third marriages, death of spouse, you wanted to provide for lifestyle, all right, ongoing income needs of the surviving spouse, but ultimately you would like the capital to pass on to your children, right? Again, a trust delivers that.
Yeah, it is such a valuable tool for many families. So I think you made the point very clear. And I agree with you, Michelle. Something to not be afraid of. But really, it is about educating, isn't it?
I applaud you. Trusts are a fantastic tool. The obligation for a formal express trust, the additional obligation is Schedule 15. What is really catching people off guard, particularly for 2023 reporting, is the bare trust and awareness of where a bare trust, in fact, is considered. And, bare trust is not formally defined in the Income Tax Act. So there's a lot of questions and uncertainty, even within the professional tax community, of what applies. My guidance in this situation is be conservative. The information that you're providing CRA, all right, in terms of your social insurance number, they already have that. They already have in terms of where you reside because you prepare a personal tax return. Going forward and being conservative and just preparing this T3 jacket and doing the Schedule 15 for a bare trust, you're not giving them additional information. You're not identifying the asset, the value of the asset, or any income or gains. Be conservative and just go in terms of approach and prepare it.
Yeah, yeah, that's a good tip, good advice for people. I would love to see them actually change the year-end reporting then, so it matches when you actually have to file returns, because it seems like that's not in sync.
Oh, you've touched on a really sore point in the tax community is T3s. So preparing a trust return, which would include ETFs, mutual fund trusts, all have that March 30th or 31st deadline. All right. And that's when they, in fact, distribute their T3 slips. So in the tax community, if you want to, show anxiety or get them on ire, is if those investments are housed within a trust, you've got competing deadlines. And in terms of you may not get that T3 slip reporting income or gains or distributions. And if the trust, in fact, also has to file that deadline for March 30th, 31st, it causes a lot of anxiety. I would like to see the distinction between a private trust, such as the inter vivos, testamentary trust, and then commercial trusts. And also be clear, black and white, what is considered a bare trust, what is in terms of express trust. Generally, you have the three certainties. There's no issue there, but provide guidance to Canadians. Like, you're not trying to generate uncertainty. You're not trying to generate unnecessary tax compliance fees. CRA should allow Canadians, such as you and I, the ability or in terms of the support in filing such returns where a bare trust exists.
Yeah, and I still go back to I understand the transparency piece. I just don't understand why they need it. What is the next step that's going to come is kind of going in the back of my mind. I would love to see mainstream media cover this because typically the average Canadian watches mainstream media, and a lot of people don't have advisors. They don't have people like you informing them if they don't have.
Or you, like I said, I'm kudos to you for raising awareness on this.
Yeah. Well, I let's hope that we get more coverage because I think this is going to throw a lot of people off. Michelle, I really appreciate your time today and just the fantastic explanation. Like I said, I've gone through this a couple of times this week, and even I was scratching my head. And so, if I am, I can't imagine how confusing it is for a lot of people. Now, Michelle, before I end the show, I love to ask my guests three rapid fire questions. I feel it humanizes finance. So, are you ready to play?
Sure, let him rip. I hope I pass.
Michelle, what is the best financial advice you've ever received?
Oh, very clearly budget and reconcile your bank account, checking account each month.
Do people still do that?
I do to the penny.
Yeah. Oh,
And
that's great. No, well,
so,
I look at my bank statement, but we don't get the passbooks like we did back when I was a child.
no, I reconcile because, just bank fees. I hate paying bank fees. So, in terms of having the minimum amount that I don't get the bank fee, cash flow management. I have three very active teenagers. One's in university, so he actually reached out last week and said, "Mom, I don't have enough money in my account to pay my rent. Can you help me?" And just in terms of being a mom, paying bills. I don't like paying interest charges. From that end. So I reconcile our account to the penny.
Good for you. Yeah, I don't like paying extra bank fees either, or interest fees on credit cards. So I just have everything automatically set up. Okay, what is the worst financial advice you've received?
Pay yourself first.
Oh, you think that's the worst?
I think it has to be distinguished as to what that means clearly. If you talk to certain generations, it's particularly, oh, well, life is worth living. The dichotomy of whether I spend now and don't save, so I don't have anything in the future, versus if I save now, I can spend in the future, is something that I don't think resonates with pay yourself first, particularly with younger generations. We are in uncertain times. Interest rates, like talking about, sorry, I'm going to mention this one thing. Everybody's going to be shocked if you don't pay your tax liability or you have not paid your installments, suggested installments for this year. The interest rate that is going to be charged or levied on the insufficient funds by CRA is going to shock everybody as compared to 2 years ago. Like, CRA is not the cheapest bank around. And I think for younger generations or those, try a little bit harder just to make sure you've got some extra spending money or funds that are, for 3 months on hand.
The emergency fund. Yeah.
The emergency fund and saving a little bit now, the importance of such, um, can't be underscored.
So important. So important. Okay, last question. If you could enact a law that would help Canadians with their financial well being, what would it be?
I am actually going to steal one of my favorite Sejal lines. I think you were talking with Doug Ford, or the education minister, a couple of months ago. I firmly believe that, much like in terms of going through school, we should have taken shop, we should have taken home ec, there should be a finance course. And it should be one of the 30 credits that Ontario Secondary School Diploma that you need to get your secondary school diploma. Learning how to balance your checking account, recognition of credit cards that, the tactile, like, oh, I'm just going to put it on my debit card or, whatever. I've gone around through CPA Canada and have done wealth literacy courses, financial literacy courses to elementary and secondary school students. And, by and large, there's a lot to learn in terms of financial independence, in terms of financial literacy, what basic investments are. Again, save now, spend later. Speaking to, your audience, how many of us have had children that just have to have something because they see it, but yet in a week later, there's something better that they want, but yet they've spent their allowance or in terms of spent their funds. Articulating that to students, I've gone out and they think nothing of spending $15 a day for lunch.
Because Michelle, they don't understand the concept of money, right? And like you and I've talked about many times in the conversation that I am having with the Ontario government, Minister Lecce as well as Premier Ford, is this, that, most of the financial literacy, they're not learning it from home because often the parents don't know. So it'll be exciting times. I will tell you that I had a call with the education minister team yesterday. So we will see how this all transpires. But I did say, like, this is something I am pushing for. We need to make it mandatory, and it has to be a 1 semester course. There's no reason why Ontario can't do it. In fact, Saskatchewan is the first province to enact this. We now have 30 states in the U.S. that mandate it as I think it's 25 that actually mandated it as a 1 semester instruction. So we need to step up. So,
Well,
Michelle,
if you need help building out the curriculum, you've got my support.
Yeah. I think I have the support for a lot of people, and every parent that I talk to says they want this. They want to see their kids set up for success. They don't know how to help, so let's hope that this transfers.
Sorry, not to take you off, but would you also mandate it? Like, would wealth dealers also provide courses, say, to the 8 to 12 crowd or 12 to 17 crowd, promote it? I regularly, in terms of with the families that I deal with, will do sessions on wealth literacy. And it's something that I think in terms of the community that we operate in and in terms of our peers, we also can do more. I think, education definitely is the first foray, but broaching it such as you are, let's just keep it up.
I think
Let's
so.
help the next
Well,
generation.
you got my support on that one too, Michelle. Thanks again for coming on.
Oh, thanks again for asking, and be well.
You too. Well, that does it for this episode of Strictly Money. If you have any questions, drop me an email or comment below. And don't forget to subscribe. We'll see you back here next week. Until then, stay well, stay wise, and stay wealthy.